Welcome to the big interview on the June 2nd edition of Money Life. Returning to the show today, Brian Jacobsen, Chief Economist at Annex Wealth Management. If you want to learn more about him and the firm, if you want to find his commentaries, go to annexwealth.com. Brian Jacobsen, welcome back to Money Life.
Thanks so much for having me. It's great to be back.
We last spoke at the beginning of the year. And of course, we couldn't have foreseen where things would go. But I'm curious because we're now into June. So this is the time when people make their, what's going to happen for the rest of the year kinds of forecasts. When you consider where we are right now, how different is what you see the rest of the year looking from what you would have thought back in January? In other words, are the outcomes that were on the table for you when we last talked and we were entering the year still the outcomes you expect this year?
Not entirely. I'd say that some of it is and some of it isn't. Probably the biggest thing that has changed relative to where I thought we would be by now from the beginning of the year is with monetary policy. I thought by this point, the Federal Reserve would have continued to cut rates. And so we'd probably be close to a full percentage point lower with the federal funds rate. I was expecting some market turbulence around tariff talk because we know that candidate Trump really did campaign on a platform of, let's say, 10% universal tariffs, probably 60% tariffs on China. And so I wasn't too surprised when that's where we've almost settled at 10% and actually 30%, but it was really shocking. And I almost kind of threw out all of my predictions on April 2nd on Liberation Day, where I saw the poster board with all the numbers on there and all the countries about what the tariffs would look like. And I think a lot of investors did something similar. They saw that and they thought, oh, great, there goes all of my forecasts. But it's a good thing I didn't throw out all those papers, because it does come to find out that that was the starting point for negotiations. And we have to see how this evolves now in terms of where do we end up with tariffs on China? Is it going to, what does happens in terms of the court system as well when they weigh in on it? So I would say that the biggest thing that I got wrong was where we are with rates with the Fed. And the thing I'm most proud of, even though I really shouldn't be because I didn't get it completely right, you could even argue that it wasn't even close, was that we'd see a little bit of turbulence in the first part of the year. It was a lot more than I was expecting.
Yes, but a lot more turbulence than you might have expected, but a market that if we had to draw a trend line from January to the start of January to the start of June, basically flat.
Well, that's a great point. And that's the nice thing. If you look at, let's say, annual data instead of intra-year data, you can do that. But it's about then behaviorally, right? How is it that investors respond to the volatility? And this is the story of investing in general. If you look at some of those charts about what are the returns over 1 year and then 5 years and then 10 years, it can give you a lot of comfort to know that, okay, typically the stock market goes up. But you can also kind of flip that around, and some people have done this, and it's some great charts about the likelihood of seeing a bear market during that time frame, right? Is knowing that you have to stay with the ride to get from the start to the end, and that's the part that, from an investor's behavior perspective, can be the most challenging.
Well, I don't know that I would have even said that the things that you criticize yourself for getting wrong, that you got wrong. I think some of those things were unforeseeable. But do we get to the end of the year again? Because at some point the year's just one data point and go, okay, but we're pretty close to what I thought was going to happen because you weren't expecting big recession, et cetera, when we entered the year. So given that, are we going to get to the end of the year kind of where you thought we'd be, even though the ride to get there totally different?
I do. I still think we will make it through this year without a recession. If we look at what the market did from February 19th to the April 9th intraday low, the market was pricing in almost the certainty of a recession. So that's with the 20% drawdown, slightly more than that intraday. But then the rapid rebound when suddenly the temperature was turned down a little bit in terms of the tariffs. And I think that's a key thing. We did have a negative gross domestic product print for the first quarter. We know that most of that was because of front loading of inventories, especially with computer equipment. So a lot of that, as far as the imports, went into inventory. Consumer spending has stayed relatively strong. And I think that we aren't going to get 2 quarters in a row of negative GDP, if that's a definition of a recession. Another one would be in terms of like a broader one that the National Bureau of Economic Research use, which is kind of you have this broad-based decline in economic activity that lasts, more than just a short period of time. I don't think we're necessarily going to see that. The most recent data that we have gotten that has been the most dismal has been more about sentiment and confidence. But consumer sentiment and consumer confidence don't correlate very well to how people actually spend their money because people engage in retail therapy. If they're feeling bad, they'll still go shopping. They also celebrate by going shopping, right? So as long as we've got the job creation, wages are growing, I think consumers are still going to do what consumers do best, which is consume.
For all of that, having watched the market get thrown pretty far sideways given what happened with tariffs and knowing that we got no real clue right now, you kind of think, okay, we could get a baseline of 15% across the board because that almost certainly can be put through no matter what the courts say, et cetera. But not knowing how it's going to play out. How tenuous is a forecast of no recession? Like if we had not seen the administration back away from tariffs, if it had not been a negotiating point, at least to that point, would we have seen recession? Like the market was pricing it in. The market prices in a lot of things that don't happen.
That's true. I think it was Paul Samuelson all the way back in the 1970s said something about how the stock market predicted like 9 out of the last 5 recessions or whatever that number was, right? And that was back in the 70s. And now the market has predicted a lot more recessions than what have actually happened. But I do think the market was getting that right. If those numbers were where we were going to land with tariffs, I think that would have caused a recession. I just have the confidence that that's not where we're going to end up. That, in terms of like negotiations, there's 2 different types of approaches. You can use the foot in the door approach, right? Ask for a small thing and then you ask for something bigger. Or you can have the door in the face technique, which is you start with a ridiculously large request. And then when they say no, or people balk at it, you ask for something a little bit less ridiculous. And then it seems reasonable in comparison. And that's kind of what the Trump administration has done with negotiations, starting off with a ridiculously high number, which would have been recessionary, and then ending up at something like, let's say, 10%, 30% on China. To me, that we could take in stride. And actually, I do find this new uncertainty around what will the administration do actually building my confidence that there won't be a recession, mainly because it really caps that upside. Like you said, like a Section 122 tariff, that could be up to 15% for 150 days. Okay, so it can't be pushed up to 20%, 30%, 145%. And then during that 150-day window, then he can maybe do the Section 301 investigations about country specific tariffs, Section 232 tariffs, which are more sector specific. But I think it kind of caps the upside of tariffs, which really dampens or lowers the probability of actually seeing a recession this year.
As for what we have seen, how much do you worry while the economic damage and the market damage fleeting and pretty quickly forgotten in the big scheme of things? The rest of the damage, the things that will help support the economy moving forward, the what you need out of foreign nations when you realize that for whatever we want to talk about, the thing we export the most of is our debt and things along those lines. Are you worried that those impacts are long lasting and that there will be a price to pay for that we don't really recognize right now?
Yeah, I think that is the bigger risk. It's the profligacy, right? The fact that under the budget, the one beautiful bill, that it doesn't really reduce deficits relative to where we are. And then it's all of a sudden you've got a lot more debt that needs to be financed. And the blessing of having more imports than exports is we get to, as you said it, we get to export our debt because that's the flip side. A current account deficit is a capital account surplus. That's kind of the basics in economics is this needs to be financed. And so the only way to lower the deficit on a longer term basis would be to get the government's debt under control, because otherwise we have to increase savings domestically or decrease private sector investment. The only time those types of adjustments happen, especially the reduction in investment, is in recessionary periods. Or when people are fearful, they increase their savings. And so to me, that's not really a desirable way to deal with a trade deficit, is to induce a recession. And so I think that unless we do get the deficit under control, get onto that path to fiscal sustainability, we're going to continue to see all this massive bond market volatility, because rates are about where they are today. I think a good chunk of it is because of fear about what deficits in the future are going to look like, because it doesn't really look like there's a way to get them back under control.
Well, you talked about how the area that you felt you did not have it correct at the start of the year was with what was happening with rates. And you thought we'd see cuts. I'm not sure we're seeing cuts this year. What do you think?
Yeah, I can see the argument that we might not get cuts this year, because if you look at it through the lens of a central bank that got it wrong with inflation going up, them saying that it was going to be transitory, they are a little shy about getting it wrong again. They would much rather make a mistake in probably keeping rates where they are for a longer period of time than to make the mistake of cutting only to see inflation rising. Now, I think that some of the data, and this is very tentative, the PCE deflator, so the Fed's preferred measure of inflation that we got this past week, it did show that we are pretty close to their target. So almost like kind of pre-tariffs, we were getting to their target. Now, post-tariffs, if we do say that we're going to say have 20% tariffs almost across the board, that would be almost too much, I think, for the Fed to stomach in terms of the price increase and the temporary inflation that would come from that. But I don't think we're going to get to the 20% tariffs. I think it is going to settle in closer to 10, in which case that leads me to believe that we can still get maybe two more rate cuts this year. But a lot does depend on things that are outside of your control, my control, and the Fed's control, which is what comes out of the White House.
You talked about the bond market. At least on my reading of it, the stock market and the bond market are sending different messages. Now, you're an economist, so it's important that the stock market and the bond market are much less what you look at than the economic numbers, unless I somehow badly misunderstand your job. At the same time, I at least find that when the stock market and the bond market disagree, the bond market tends to win out. So, given that you think that conditions are fairly benign, do you think that the bond market is maybe the place that's too worried right now and that it's not going to win out in this disagreement?
Yeah, so right now, the way that I'm looking at it is that the bond market, especially if we're looking at the treasury market, is sending the signal more along the lines of, look, there are lots of things to worry about. Well, the stock market is saying no, everything is fine. So very conflicting signals. But then when we look at credit spreads, about how narrow those are, that's sending the message that no, things on the private sector side are fine. And so that's where I draw the distinction, is between what's really driving the volatility in the fixed income market. It's not so much spread or economic risks as reflected there. It's more rates, which can reflect, oftentimes it's about the view of growth, the view of inflation, but there's also a risk premium that we've sort of forgotten about over the last 20, 30 years. Back in the 70s and 80s, there is a lot more of a risk premium built into treasury securities about the future of growth and inflation. Because as much as what rates reflect the expectations of growth and inflation, it also needs to account for the uncertainty around those forecasts. And that's where I think that the bond market has it right and the stock market has it right, is it's because of the uncertainty around, especially that inflation side of things. If we don't get the government debt under control, at what point does it need to start to be monetized, which then becomes much more inflationary? Or at what point does it squeeze out or crowd out private sector activity, and then it becomes a real drag on growth?
let's move from what we're seeing here to what you're seeing around the world. Because all the other nations that are on the receiving end of tariffs, their economies are being affected, their things are happening. We talked a little bit about the broad impacts, but economically speaking, it's always been said that if the United States catches the sniffles, the rest of the world gets a cold. If we've got whatever struggles we're having, is it much worse for them, or is that where the opportunity lies?
That's where I think that there is some of the opportunity from the investing perspective. And this is where we have to draw the distinction between the economy and the markets in those areas, mainly because people had thrown in the towel over the last 15 years due to dramatic underperformance in, say, Europe. And so, in a way, garbage at the right price becomes pretty valuable. And I think now people are recognizing that valuations in Europe are at attractive enough levels, even though we have seen those markets outperform year to date. That's only after 15 plus years of underperforming rather dramatically. They do have still continued structural issues. Yeah, I think that their trade dependence on the United States, trade dependence on China, and now all of a sudden the United States says no more on that. It does put them in, from an economic perspective, a very uncomfortable position. But the businesses, right, the investment opportunity set, some of these businesses, they aren't just domestically focused on their own home countries. So much more of their revenue comes from outside of their countries than what we have here in the United States. And so that's, I think, another way to really kind of look at that is just think of it in terms of what is their actual geographic revenue exposure. And then that can kind of highlight where there continues to be some opportunity. So economically, they could face some challenges, but think about some of the companies in Japan, about their profit growth, the extent to which that has dramatically outstripped their GDP growth over there. So it just shows that there is that wedge between what happens with the companies versus what happens within the countries.
It's a very interesting time to watch all of this. As an economist, you don't want to be making forecasts that you got to change week by week, moment by moment. As much as I like getting, and I do read your market musings, which you send out on a regular basis, et cetera, you don't really want to have to change things. How much do you worry, if at all, about headline risks, the stuff we've talked about, literally changing the situation overnight? In other words, that you wake up tomorrow and instead of going, it's a lovely day and the sky is blue, the market has decided the sky is green or what have you for any of the possible headliners. I mean, we got war, we've got other things going on. Is the suddenness here something that we have to accept because we're just not going to have certainty for a protracted period of time, perhaps the rest of this presidential administration?
Yeah, one of the things that I sometimes remind myself is that if I want certainty, that's why I go to church. That's why I look at math, right? When we're dealing with the world here of politics, economics, and markets where they all intersect, there's never going to be that certainty. It's just that it's like certain uncertainty times two, or if not uncertainty squared in this type of situation. And I do think we are just going to have to accept that very much like during the first Trump administration. Even though, interestingly, during the first Trump administration, the VIX, so the volatility index, or even the volatility as you actually measure it day by day moves, was unusually low. So, despite the policy uncertainty, I think people just have to get readjusted a little bit to the bluster and then we'll probably be able to sleep a little bit better at night because at this point, suddenly it's Wednesday evening and you know that out of the blue comes a ruling from the Court of International Trade that most people had never heard about, or it's a Saturday and all of a sudden you hear that there's going to be tariffs on some country. You're sitting at the bar with your family, enjoying your time itself. So always having to be tuned in. So I think that at some point we're just going to get maybe a little numb to it and just be like, okay, that's just, I guess, business as usual. That's just how it goes. But is it actually going to change the fundamentals of Apple? Will it actually change the fundamentals of the companies that you can invest in? Sometimes it can. So it's important to pay attention. But a lot of times, the initial noise, the initial banging of the gong that we hear, maybe we just don't need to kind of quick and turn and look at it all the time. We can just be like, we'll just see how this shakes out.
if you and I don't talk again for about 6 months, which is likely when we will be talking again, we'll be talking as we get into December. Will we look at this as a year where we're asking all the normal December questions? Santa Claus rally, January effect. What's your outlook? Do we continue the hot streak that we've had? Or will we not be able to get to that because, there's just too much unforeseeable stuff that can reign the game?
Well, so this is maybe a little bit of downside risk where what if the administration isn't able to, at that point, get this one big, beautiful bill through Congress? And so we're not just talking about, is there going to be a Santa Claus rally? It could be about, is there going to be coal in our stockings because we have a fiscal cliff? In my mind, that's one of the bigger risks here, is that because of the narrow margin by which that bill came out of the House, and now the modifications that are going to likely be done in the Senate, trying to get this reconciled back in the House, that could be a protracted enough discussion where we're probably going to shift from so much tariff uncertainty to now tax policy uncertainty. So I don't want to be, economists were kind of famous for pointing out the cloud behind every silver lining, but I have a feeling that come December, we might be talking about, fiscal cliff 2025.
Well, the silver lining in having that out there is that you and I will have that discussion. And however it turns out, it'll be fun to chat with you again. Brian, thanks so much for taking the time.
Thank you. I really appreciate it.
That's Brian Jacobsen, Chief Economist at Annex Wealth Management. AnnexWealth.com if you're looking for more information on him and the firm. And we will come back and set you up for the rest of this week. Remind you what's coming. We got a spectacular June lineup. You want to hear all about it, so make sure you do before we wrap this one up right after this message.